Okay, right. Well, I think let's get started then. So thanks everyone for joining. So it's a buy-to-let mortgage masterclass, but we've got Nabil here from Taxes Done Right. Um, he's our property tax expert, our go-to guy. He's an investor himself and works with a lot of investor clients as well. So we'll get started just for everyone's benefit on here. This webinar is recorded. We can send you a copy of the recording afterwards, and the usual disclaimers apply. So, this is not intended to be specific professional advice to you. We always recommend booking in some time with myself or Nabil, and we can give you a personalized professional advice. And as always, your home and property might be repossessed if you don't keep up your mortgage payment. So it is important that you pay attention to that. So, right, so a little bit about myself. So I'm Daryl Kai from from DK Financial. I'm a property investor. I started in 2008, so I've been investing for a while now. I qualified as an accountant in 2011, and I started DK Financial Services really off the back of not being able to get the right mortgage advice from someone that understands the tax implications, how to structure things properly. So I really set DK Financial up for myself initially, and it's grown since then. And as it says there, we've been featured in the Times for I think the last 4 years now. I'll pass over to Nabil.
Yeah, hi. My name is Nabil. As Dara has briefly introduced me earlier, I'm a qualified accountant. I've been in this industry for the past 15 odd years. I'm a property investor as well for the past five-ish years, I suppose. I started up Taxes Done Right a couple of years ago, and I specialize in providing accountancy and taxation support to small owner-managed businesses, like landlords, etc.
Yeah,
Yeah.
brilliant. So a little bit about us at DK Financial. We're a whole of market mortgage advisor. We work with over 100 lenders. We've got lots of specialist lenders on panel, which allows us to make sure we're finding the right lender for you. We've arranged over 500 million of lending. There's a team of 7 of us, so you're well covered. We've got 5 specialist advisors, and doing the maths between us, over 100 years of mortgage and finance experience.
Yeah, so like I said, I started up this practice a couple of years ago. I'm a qualified accountant, and I've got a team of 3 working alongside me. So we specialize in, providing personalized support and advice to small or managed businesses. And we provide end-to-end services from bookkeeping to taxation, VAT, and whatnot. So yeah, it's a brief intro.
Great. Just quickly, a couple of charity partners we work with. 1% of our turnover goes towards the charity partners that we work with as well. Right, so to get in started, while you're all here, so we're going to talk about buy-to-let first, and really we wanted to cover the structure, which is what we're getting a lot of questions about at the moment. So broadly speaking, you can have your buy-to-let structured via limited company, also known as SPV, or in personal ownership. Now, what is best for you depends on your current position and your long-term goals. There are some key differences that Nabil's going to cover. They're treated differently for tax purposes, and the costs involved in both can differ markedly as well. So it is important that you know which avenue you're going down and which route is best for you.
Yeah, so like Daryl said, there are a couple of structures which you can look at, but generally limited company ownership is only beneficial if you are looking for a long-term strategy and you are a higher taxpayer. Many people trip over very easily when they hear, oh, Section 24 mortgage interest relief is not allowable under personal ownership. It's correct, but you do still get mortgage interest relief on your tax calculation. So if you're a basic taxpayer, generally mortgage interest doesn't disallowance or mortgage interest as an expense doesn't make any difference. But again, like we said earlier, there is no one size fits all thing. It really depends. So on a personal side, there are higher rates. For example, obviously with the recent budget, the property tax has been introduced as a new tax. So the rates are going up to 22%, 42%, and then 47% respectively for basic, higher, and additional rate taxpayers versus corporation tax, which is maximum 25% and then minimum 19%, depending on the profits you're looking at. But generally, with limited company structure, people do not wish to withdraw the money from the company because it's like more of a passive income. They like to invest for long-term purposes, which is why if you're a high rate taxpayer, you're comparing maximum of 25% against 42%, or if you're a decent rate taxpayer, 47%. It's generally easier if you have a portfolio within a limited company to scale up because you are not taking out the money, you are effectively reinvesting that money to buy future properties and for investment properties. Now, with regards to the control and then liability, etc. So limited company gives you more control in terms of how and when you will be withdrawing the money from the company. Obviously, if you withdraw as dividends, then you'll pay taxes. But generally, people, if they want to withdraw, they'll be withdrawing as director's loan repayment, etc. But like we said earlier, limited company ownership is better for long-term planning, such as inheritance tax, etc. Yeah, can we move on, please? Yeah, so we are getting many questions from landlords who currently own properties under their personal name, asking questions, especially after this recent budget, that what are the costs involved, whether there is any way to mitigate any tax liability if they were to transfer the property onto a limited company. What we have to understand is, like I said earlier, it's not a one-size-fits-all thing. There are a couple of numbers, variable, moving parts, etc., which we have to look at. But generally, if you have a couple of properties, then you can't really avoid capital gains and stamp duty. Capital gains will be payable by you, subject to normal capital gains rules, and stamp duty will be payable by limited company. Now, the recent questions we are getting, and obviously there are many social media and YouTubers, etc., they are talking about Section 162, which is incorporation relief, and then more precisely referring to Ramsay versus HMRC case, where the upper tribunal concluded the case with some of the remarks where it talked about the 20 hours rule, and this in their case, it was supposed to be a passive income, sorry, not to be passive income and an investment income. Now, the 20-hour test can be interpreted in different ways, okay? In their case, it was that they had no other income and they were actually working 20 hours or more, okay? Now, it's up to you to justify to HMRC whether, in case of investigation, whether you qualify for the 20 hours test. But recently, within this recent budget, one of the fine print of the budget was that previously this incorporation relief was automated. So you didn't have to reclaim this incorporation relief on your self-assessment. But now HMRC will be introducing some additional sections on self-assessment where they will be requiring you to declare this on your self-assessment, which we believe within the accountancy sector that this is so that they can track and probably scrutinize or question the relief if they feel that, it's more of a passive income than an investment income, or, so, I mean, there has been other cases as well on similar topic, but one of the key thing here is that people say, oh, if I have 4 properties, or 5 properties, I am running effectively a business, okay? But if those properties are being managed by an estate agent, you are not effectively doing anything, okay? So let's compare it with someone who's got 100 properties and all of them are managed by a estate agent versus someone who's got, I don't know, 10 properties, but all of these properties are managed by him. So in this case, personally, I would see the second person to be running a business because it is managed by him or her, and they would be spending, I don't know, more than 20 hours in this example, whereas the other person who's got 100 properties, he's got a hands-on approach and his estate agents are managing those properties. So I would highly doubt that they would be running a business, which is where incorporation relief will not apply, okay? Now, the other thing which people don't think of is about the exchange of share, because when you transfer the business over to a limited company, it's transferred as transfer of going concern, which is this TOGC, in exchange of shares. So what happens here is that when you transfer the business to a limited company, your equity is tied into a share capital of the company, which means you cannot withdraw that money unless you sell the shares in the company. And you can only sell those shares when you actually dispose of the property and close down your limited company. Okay. Now, this in contrast with a classic limited company purchase. If you buy a limited property and the limited company outright, when I say outright, like not transfer it, then your equity will be sitting as director's loan in the company, which means you can withdraw that director's loan if you wish to. You don't have to, but if you wish to, and then you can use that money to, I don't know, put money into pension or whatever do you want to do it if you wish to withdraw. But with this transfer of going concern and exchange of shares will mean the money are tied in that limited company until the property or the shares are sold. Yeah, if you can move on, please.
Right, so I'll cover some of the key criteria around buy-to-let, just more in general. A lot of you are asking about the term portfolio landlord. It does vary ever so slightly between the lenders. Some of them will class you as a portfolio landlord if you've got 4 or more buy-to-let. Some of them distinguish it and say only if you've got 4 or more mortgaged buy-to-lets. So some clients can fall in that narrow gap where maybe they have more than 4, but not more than 4 mortgaged. Yeah, but basically 4 or more properties with most lenders, you're going to be a portfolio landlord and you fall under slightly different rules. 2 ways that we tend to set up the buy-to-lets. You can do interest only. Most of my investor clients do go down the interest only route. It's better for cash flow and it means that you have more cash then to invest in the next project or property or whatever you're looking to do. You can still make overpayments, generally around 10% per year if you, as and when wanted to. But we have a handful of clients that just feel more comfortable with a repayment mortgage similar to your residential. That will pay the mortgage off over time. And when I ask them what their goal and strategy is with that, normally it's around legacy planning and planning to pass that property on unencumbered to family. 6-month rule, a lot of you are asking about. With almost all lenders, there's a couple that don't require this, but you need to own the property for 6 months before you can remortgage it. It's an old rule that came in after the 2008 crash to stop some money laundering that was happening at the time. So once you buy a property, you might want to get some refurbishment works done. Typically, we need to wait 6 months before we can go back and pull any extra money out from the added value. But that's where it's key to be upfront with your advisor about what you're looking to do. Because if you are looking to take money out within 6 months, and I've done projects like this myself, there's a couple of lenders where we can do that. So we just need to make sure we're with the right lender from the outset. In terms of income, most lenders have a £25,000 minimum income. It's preferred, but there are lenders that don't have any minimum income. Some lenders require an element of self-employed or employed income, and they won't include any land and property profit. Other lenders are a little bit more flexible. And again, homeowners preferred, but it's not essential. If you're not a homeowner trying to get involved in buy-to-let, we can do it. We have done it for clients. The clients just need to the lenders just need to satisfy themselves that the clients aren't going to move into the property in what they term a backdoor residential mortgage. So your advisor should be able to discuss that with you as well. Some example rates here. Now, obviously, I will just stress that these rates are indicative example rates. I've picked some rates when I set this presentation up that included no fees for personal ownership and limited company ownership, just so that we could compare like for like. So in personal ownership at the moment, with a 25% deposit, which is generally our minimum recommended. We can go less than 25%, but it just gets very, very difficult with the interest rate, with the stress tests, which we'll come on to in a minute. So we recommend 25% minimum deposit. Personal ownership, you're looking around 4.5%. Again, that is just an indicative rate, and your advisor will be able to run through the specifics with you. There is a slight premium to go down the limited company route. Lenders typically at the moment charging around 5.5%. Now that difference between personal and limited company, that is getting narrower as more and more lenders are coming into the limited company space. Majority of my new investors definitely, and most of them are going down the limited company route. And as more clients go down this route, more lenders are waking up and seeing that actually they're missing quite a big chunk of the pie here. So we've had the likes of BM, who you might have heard of, very big in buy-to-let space. They've launched limited company this year, and there's rumours Santander, NatWest, and the likes are also going to be launching soon. So once you get these high street lenders in the limited company space, that's just going to put pressure on their margins, and I expect to see that 1% difference narrow down a little bit going forward. As I said, there's lower rates available if we look at product fees. Product fees do tend to be a little bit higher on the limited company side again, but that difference may come down. And what's important, and I would stress this, is it's important to look at the overall cost of your deals. So it's the interest rate plus your product fee plus any other fees that are levied. And you need to look at that over the full term to get a true indicative cost. It may be that a lower rate with a 1, 2, or 3% fee might work out cheaper. It just depends on the particular numbers you're looking at. And with all buy-to-lets, it's the rental income that drives the mortgage amount that you can look at. And I'm going to go on to this in a minute with the stress test. So how much can you borrow? That is a very common question, a very good question. So how the lenders work this out is they use a stress test. So what the lender is saying is that your rent must cover your interest-only mortgage by 125 to 145%. But that interest-only mortgage is not at what the rate that you're actually paying. They stress test it a little bit just to allow for any interest rate increases over the term. So typically we're looking at a 5.5% stress test. That does vary depending on the market. Around the time of the Liz Truss mini budget, they were stress testing at 8 or 9%. At the moment, we're stress testing around 5.5%. So what they're saying is your rent must be 125 to 145% of what your mortgage payments would be if you were at 5.5%. We're getting a lot of questions around short-term lets and holiday lets. So I thought I'd cover this off here as well. The way the lenders work this out is they'll take in a 30 weeks average rental income using the average of high season, medium season, low season. Most holiday letting agents will be able to provide those numbers to you for your area. However, a lot of lenders are still just taking the AST figure, which is the tenancy figure, if you were just to let the property out on an assured short hold tenancy. So the stress test that I keep talking to here is a worked example. So you take the mortgage amount that you're looking at, you times it by 5.5%. So in the example here, we're looking at a mortgage for 200,000, let's say, at 5.5%. Here's £11,000. That's for the whole year. Divide that by 12, gets you about £916 per month. Then we multiply that by, in this case, we're using 145%. That's typically used for higher rate taxpayers. If you're a lower rate taxpayer or you're looking at a limited company, typically it's 125%, but it does vary. So you would times that 916 by 1.45, and that would give you your rent required of 1,330 per month. That's what we mean when we're talking about the stress test, and your advisor will be able to run through that for any particular properties and rental amounts that you've got, or they'll be able to work it out and tell you what you would need the rent to value at.
Right, yeah. So we've done a case study based on someone being a basic rate taxpayer and a high rate taxpayer. So the first slide, which you can see on the screen, is talking about for a basic rate taxpayer case study. So we've just used basic numbers, although it's Darrell's property apparently. And so we've used the numbers he's provided. So in this example, what we have assumed is interest rate for personal ownership is 4.5% and for limited company is 5.5%, and there is no product fee. So everything else remains the same. So you'll see the retained profits within sole ownership is more, about that 800-ish pound versus limited company. Okay. Now this is only because of someone is a basic year taxpayer. And like I said earlier, if it is a basic year taxpayer, it's probably better to keep it under business under personal name rather than to a limited company. Okay. Now, if you wish to withdraw the money in this scenario from limited company, then your net income will drop further because you'll have dividends tax to pay, assuming you withdraw the money as dividends. If you withdraw as, I don't know, director's loan, if there is any, then obviously this would remain the same. So it's just a brief overview. If you are a basic year taxpayer, how the numbers will look like. And just to reiterate, if you are a basic year taxpayer, the mortgage interest relief, Section 24 relief doesn't have an impact because you still get that 20% or 22% from when the changes come in, relief. Okay, so if you just move on to the next slide, please. Yeah, so this one is for higher rate taxpayers, and this is where many people would see themselves paying more tax, being a higher rate taxpayer because their other income, for example, employment income or self-employment income, pushes them into the high rate bracket. So in this, you'll see there's a clear difference between retained profits, where sole ownership produces just over 3,200, sorry. And then for limited company, it doesn't change whether you're a higher rate taxpayer or you're a basic taxpayer, provided you're not withdrawing the money from the company. So the difference between the two slides, on the first one, you'll see the difference between higher rate limited company and personal ownership was around £800, okay, favoring personal ownership. Whereas in this, it is other way around, but almost double. So it's about £1,500-ish. You are benefiting better off under limited company. Now, having said that, and Daryl covered this in one of the previous slides as well, we do see that product fee for limited companies are quite high. Okay, you may get a lower rate. I was looking at the other day, that correct me if I'm wrong, but I was looking at the other day, there was a limited company mortgage at 4%, but the product fee was £10,000 or something. So, you know, this is possible. It's not just the rate which drives the numbers, it's the product fee as well. So, like we said earlier, it's not a one size fits all thing, and you need to get a professional advice, a customized advice, which is tailored to your individual scenario to ensure you are looking at and you're getting the best possible outcome for your investment strategies.
Yeah, absolutely. And then just to reiterate what Nabil was saying, I believe I haven't checked if it still exists. There was a product not long ago. It was around 1.5% interest, which you think, wow, the good old days, until you look at the product fee, which was 9.9%.
Wow.
So your overall cost there is 11% over two. Yeah, it's so it really is the devil's in the detail. And then it says on the slide there, it's not clear cut for every single person if you're better off in sole ownership or limited company, which is why it's always worth speaking to an experienced professional, and they can work out the specific numbers for you.
Yeah.
So how much does it cost? Well, for buy to let in general, but also for limited company, and I'll tell you which bits are relevant for which. So with across both personal and limited company, you'll likely have an arrangement fee, also called a product fee, which is what we've been calling it. You can pay that upfront or added to the loan, and that really varies from zero right up to like 9.9%. Or sometimes it's a monetary amount, like £10,000 or so. So you do need to factor that in, speak to your accountant, and they'll be able to tell you whether you can amortize that and how that will affect your numbers. Obviously, you've got the legal fee. Now, you'll need to always pay your fee and the lender's fee for acting, for the mortgage. The legal fees, we are finding they're a little bit higher in limited company. There's just a little bit more work involved, so worth getting a quote from your solicitor for that. Other costs, valuation costs do vary. They are typically included on personal buy-to-let still, much like most of the residential mortgages and remortgages are that you might have experienced. On limited company, the valuation costs do tend to be an extra, but not always. So it is worth looking for a lender that's got a free valuation, working that into the numbers. And even sometimes what we do with a lot of our clients is we'll go for the free valuation with the lender initially, make sure we're getting the valuation that we want. Once we are getting that, we can always look to change to one of their products that might work out cheaper overall, but it's got a paid valuation. But at least we know what we're getting at that point when we're paying for it. A lot of buy-to-let lenders have application fee, so that is typically £150 to £299 up front. It's charged by the lender just for putting in the application. So it is important to make sure you're keeping an eye on all of the costs. The independent legal advice, that is specific to limited companies. That is legal advice you'll need independent just for you, which basically explains that you don't, even though it's a limited liability company you're setting up, you do not have limited liability, and the lender can come after you if your company does not pay the mortgage, much like they can come after you if you don't pay your residential mortgage or your buy-to-let mortgages in your personal name. So all of the lenders pretty much now need independent legal advice, which comes at an additional cost. Accounting and tax is, whether you've got personal name buy-to-let, you'll need to do a tax return. If it's limited company, you'll need accounts preparing. And as I touched on earlier, most lenders typically allow up to about 10% overpayment on your mortgage, which is why many of our clients go interest only. It gives them the flexibility to overpay as and when they want to, without being tied in every single month for making higher payments. So that's most of the material we're covering, and I think we're just on time at 8:30. Are there any questions? So we're taking questions via the chat. If you've got any questions, please put them in the chat. And if not, we've definitely had some come in via email.
Yes, Adam, please go on. Yes, product fee can be deducted from tax, but the way it works is that it is amortized over the fixed term of the mortgage. For example, you have paid £1,000 product fee, okay, regardless whether you have added this onto the loan or you paid upfront. Over 5 years, you will amortize it. So in this example, you will reclaim as an expense £200 every year over the course of the mortgage term.
Yeah. Great question. And we had a question in via email as well, didn't we?
Yeah. Do you want me to read out the?
Yeah.
Yeah, so we've had a question from one of our clients, and she's asking, is it possible to remortgage a property and use the funds as a deposit for buy-to-let, even without having a full-time job? My previous lender refused. Thanks.
Okay. So a couple of aspects. So it is possible to remortgage property, take money out, and then use that for a buy-to-let. Not all lenders allow it. For example, nationwide, they won't let you take money out of a residential mortgage to use as a buy-to-let, but a lot of lenders do allow it. The question's not clear if it was a residential she was remortgaging or a buy-to-let. So if it's a residential, yeah, you can take money out, use it for deposit on an investment property. To take money out though on a residential, the new mortgage would still have to fit affordability. So you would still need sufficient income to show your lender, Barclays, Halifax, whoever it is, that you can still afford to make the payments based on your current income. So if you don't, well, it depends what the income is, whether you can meet their affordability requirements on that. If it's a buy-to-let mortgage that you're looking to remortgage, yeah, then absolutely, and you don't necessarily need any other income yourself personally. The remortgage of the buy-to-let to take the money out, again, is just based on the stress test, and that will dictate how much you can take out, and then you can use that as deposit on an onwards investment purchase.
I think we've got a question for you.
So thanks for that question. Can we amend the monthly payments to go higher if make higher rents? Yeah, you can speak to your lender definitely. So if you increase your rent and you want to make a monthly overpayment, yeah, you can speak to your lender and they can all arrange an overpayment facility on a monthly basis. A lot of clients prefer to make a lump sum payment at the end of the year once they've paid their tax bill, once they know how much cash they've got left. And if they're not planning to invest that cash, a lot of them will just make a lump sum overpayment. But yeah, absolutely, if you wanted to do it on a monthly basis, depending on the lender's requirements, most of them will allow a 10% overpayment per year. So as long as you're not paying more than 0.8, 0.9% per month, then yeah, that's fine.
We've got another question. I'll read out the questions. Thanks for the presentation. Both wanted to get clarification on transfer of going concern, share capital, and the other option, director's loan. Selling property to limited company, is there any way to have later incorporated? Sorry, I'm not sure what you mean. Is there any way to have later incorporated? So just to reiterate, if you are transferring a property to a limited company which is owned by you personally, then generally capital gains and stamp duty would be payable. However, you can mitigate and demonstrate it's a business rather than a passive income. Okay. I hope, sorry. Yeah. Okay, so Daryl, there's another question. I think it's for you.
Okay, yeah. So this question, thanks, Frank. What's the implications if a buy-to-let is then used as a rent-to-rent? Okay, so if you've got a buy-to-let, and then if it's being used as a rent-to-rent, I'm assuming you would be giving it to a rent-to-rent operator, that's then going to rent it out. So most lenders don't like this. If it's a standard buy-to-let mortgage, it is supposed to be used for a normal AST tenancy agreement. If it's a holiday let, you would get we would arrange a specialist holiday let mortgage. If it's rent to rent, yeah, most lenders do not like this. There are a couple of more commercially minded lenders that will allow it. The key thing I stress to all my clients, so this rent to rent, which is doing the rounds on social media, you need to be very, very careful. So there are a few reputable operators. The ones which the lenders can consider, and this is only the more commercially minded lenders, are the big players like Serco. If it's a much smaller player, then most of them will guarantee your rent. Now, I would check that guarantee and check if it's insurance backed or if they actually have the assets. I'm a property investor myself. I'm constantly approached by people offering to rent my property on a rent to rent basis. They say they'll guarantee me the rent. I ask them, okay, that's great. How long have you been operating for? Typically less than a year. They have no accounts. The accounts they do have don't have much money in. So you have to ask the question, what basis are they actually guaranteeing this on? If it's not insurance backed, then they really need assets in the company and you should be looking at their accounts to confirm that. So I'd be very, very careful with that. Normally it's not worth it. If you do want to go down that route, make sure your lender's aware. It'll probably be a more commercial lender with slightly higher rates.
Right, we've got another question from Sharon. Thanks both. If selling property in limited companies, there are capital gains on profits. So I believe you're referring that if you have a property in a limited company and you sell that property within a limited company, if so, then firstly, limited companies do not pay capital gains. Limited company pays corporation tax, and corporation tax rate is driven based on the profits. So it's between 19% and 25%. So to answer your question, yes, there will be tax to pay. What tax will be corporation tax, not capital gains tax.
Great. And then there's a higher rate tax payer that
Yeah,
would
so
be...
just to add or expand on this. Now, if you only had one property in the company and you sell that property in that company, then you will be withdrawing, assuming you'll be withdrawing that money from the company after disposal of the property. So firstly, you'll be paying capital gains tax, sorry, corporation tax. And then when you withdraw the money from the company, you'll be paying capital gains because capital gains is payable by individuals, not limited companies. But the capital gains rate will be, depending on the tax bracket you are in, 18% or 24%, again, assuming the rates do not change when you do it in the future, I suppose.
And here's a question, Nabil. Pension contributions,
Yeah,
they're tax deductible in the company, aren't they?
correct. Yeah.
So that's another question that we get asked a lot, which can help to mitigate some of the tax. Okay, great. And one more question.
Just on this, going back, sorry, Daryl, just on this pension contribution. So the care must be taken that these contributions are treated as employer contributions, not personal contribution. So when you're making a contribution via your limited company, it's your employer or deemed employer, which is your limited company, who's making the contributions, not you individually. So these contributions will only be allowed for corporation tax purposes if they are done by as a limited company rather than individually. There are different reliefs if you contribute personally, but to answer the specific questions, it has to be done as an employer contributions.
Yeah, great point. And then final question that we'll take. So yeah, no problem. Our pleasure to answer the question on that. Your current deal ends in May 2026. When should I start exploring new options, please? So all of our clients, they get an email from us 6 months before. That's when we can secure a new mortgage with a new lender that would secure a rate, does not commit us to that rate, that product, or even that lender. It does just act as an insurance policy in case the market moves against us and rates go up. So I would say probably any time from now really is a good time to start looking. You can get you can secure a rate and then you can just monitor the market as we get closer to May. If better products are available, you can always switch at that point because you're not tied in until you actually go live with your new deal. With your current lender, typically you can only look to secure something with your current lender 3 to 4 months beforehand. They're not all that. Most of them are that now. Great. Okay, well, thank you everyone for attending today. This webinar is recorded. We will send you a copy of it, so you can always go back to it. What's next, you might ask? Well, I think we might have had a couple more questions on email that we didn't get through to. If you have got questions, if we didn't answer your question, you can scan the QR code. You can book a free call with either myself or Nabil. We'll be able to help you with mortgage, tax advice. Our website's there if you want any more information. I'll leave this page up for a little bit just so you can take a photo or anything you need to. But yeah, absolutely. Any other questions? If we didn't get around to your question, apologies. Please book in. Happy to answer as many questions specific for your circumstances as well.
Yeah, definitely. Yeah. If you have any questions, just email us, or book the call, and we'll be more than happy to answer any questions you may have.
Yeah.
Brilliant. Thank you, everyone. Thank you.
Thank you, everyone.
Bye now.